Hey traders and investors, it's Serge Berger here. Today we need to have a look at the broader indices and really give you a little bit of context of what's happening in terms of sort of the choppiness that we're experiencing here at the end of the third quarter and coming into the beginning of the fourth quarter, where we tend to see a little choppiness and then ultimately may actually be setting up for a year-end rally, but that the year-end rally does stand a better chance if we actually do see a bit more meaningful of a dip. So for the time being, though, I want to just kind of point out a couple things. I got a lot of questions on this last week. If you look at particularly the large gaps, the Dow and the S&P, not so much the Russell 2000, but even the Nasdaq 100, so the more sort of techie large cap things. If we're just going to go up to a plain white chart and use the weekly base, i.e. weekly increments, you'll see that really not a whole lot has actually transpired. In fact, if we just look back, say the past 5 to 6 weeks, including part of this week, so really the past 5 weeks, you see that the Dow really hasn't done a whole lot. All we've really done is sort of oscillate above what used to be sort of resistance and oscillate sort of back and forth in a very choppy environment that is very difficult to trade, particularly the large caps that way. So from my point of view, unless we sort of break either one of the extremes, so on a weekly closing basis about 1700 on the low end, if we break below there, the short side might open up. If on the upside on a weekly closing basis above about 17,000, 270, 275-ish, something like that, it's going to be, to get long, it's going to be very difficult to really do a whole lot here. And so it ends up being sort of something where, death by 1,000 paper cuts comes to mind, where we're really just better setting out and actually looking at single name stocks as opposed to trying to play the indices, which is sort of the inverse of what you'd want to do generally in this type of more volatile period. But of course, so far the volatility has mostly been constrained to intraday as opposed to the day-to-day. So if you look at the S&P, the picture really is quite similar. You can see here on a weekly closing basis, we are still holding above that support or previous resistance area. Now support somewhere near 1980, more or less, right? You have to kind of squint a little bit or give a little bit of a leeway on this, but on a weekly closing basis, we have held this, and now we're below right now. But still, the point is this: that we're kind of just range bound as opposed to really trending, and that's again makes for a very difficult type of trade unless you're day trading. Makes for a very difficult type of environment to really press your bets. So the thing to really look for here is more sort of single name stocks that you might be able to trade with higher probabilities. Things that may look like an oversold bounce could occur. Things that look like they're about to fall lower below key resistance. But even there, you're going to be very selective and wait until something kind of gives a little bit more on the broader market, i.e. particularly including the large caps, because we all know the small caps here. I'm just bringing up the Russell 2000 ETF, the IWM. The small caps have done plenty of bearish things this year, just kind of increasingly looking heavy and dancing on this support line here. So ultimately, if and when that breaks, certainly the small caps will have more downside. And quite frankly, I think if and when the support line breaks in the Russell, the large caps should be able to follow lower as well. So I hope this makes sense, guys. Don't overtrade for the time being. If you got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader, and I'll see you in the next video.